This is Satya Pradyuman of Cirrus Research, and welcome to this episode of Market Conversation. In this episode, we walk through the market outlook. The title of our recent outlook report, The Dispatch, is Barbell the Mag 7 and Value to Close Strong in 24. We hope you enjoyed this episode, and always your comments and feedback are welcome. Thank you. This is Satya Pradyuman of Cirrus Research. This is the quarterly market outlook call that we run. The title of this call, Barbell, the Mag 7 and Value to Close Strong in 24. In this call, a lot of it will be tied back to the quarterly report that's called the Cirrus Dispatch. That walks through a lot of what I'm going to cover in a good bit of detail, probably more carefully, let's say, summarized. That said, the key themes, though, the trade right in front of us is this incredibly narrow leadership moment, or the few stocks that are running the market. The global rebound in the earnings cycle and easy credit, though, they conflict with this current state. And I think this is a big deal as we wrap up the first half of the year and we then focus out to the back half and even starting off 2025 in a strong way. Really important changes in the work in the last few months. The value reading has gone overweight. We've got a style oscillator. We haven't seen this in 20 years. I'll try to walk it through, what I think has sort of triggered this, and also relate it back to the last time this signal had gone to a value overweight. The most confounding thing that we're seeing, however, is that as much as we've seen this sort of like bifurcated market, the tactical readings still point to more speculation and not less. And there's a cruel tale in markets about leadership as they run, fundamentals suggesting to pivot away, and yet they run harder. So I'll try to reconcile this. I think this is terribly important. Looking at the value relationship, I think the small cap market is tied at the hips with a rotation to value. One data point that is new, besides of how discounted they are, the urge to merge. What we're noticing is a backdrop that is certainly more favorable for consolidation. So to some degree, the corporate buyer may place a full floor in the small cap market. And then another super important topic is this idea about an industrial super cycle. Last few years, we've been very bullish on spending, industrial spending for CapEx. And really in parallel, we've seen technology spending, the CapEx data really slow until recently. So I want to reconcile that and also underscore why we still believe we're in a multi-year run for industrial spending. And so, getting back to the overall market, the single thread of leadership that's underway, it is fundamentally in conflict with what we're looking at in terms of the global profit cycle. Earnings growth are on the mend. Credit is fairly stable, quite easy. Jobs data is rebounding. In fact, in the US, we've got record low unemployment that continues. And in fact, when we look globally, central bankers are clearly reversing course and have begun to cut rates. Clearly, the US is the big question mark. Most of the consensus is fairly bullish on the fact that we will probably get a cut this year. Given this sort of like stabilization, potentially soft landing, market returns are positive, but they're meager in light of what we've been seeing in terms of the reality of the economic recovery, stabilization. Investors have truly chased like the Mag 7, Bitcoin, GLP-1 themes, some of the Ozempic sort of investment themes. But overall, though, returns are mixed. The S&P, yes, it's up 16%. And we've got multiples of that when it comes to the several firms in the Mag 7 basket. That said, though, if you look a little underneath, what we're looking at is a 5% rate of return on the mid-cap market and about a 1% gain on smaller stocks. So when we think about how an index performs, what's driving it, I'm sure we've all seen headlines and charts of the record amount of market cap that's held within just a few firms. So, really at the end of the day, though, how do we reconcile this? Because at the same time, we've got fairly robust spending on very narrow themes in the market. Clearly at the forefront of this is AI. That said, there's a lot of angst on how to pivot the portfolio, how we look to close this year, especially strong if we wanted to. Do we continue to really chase the trend here? And ultimately, I think maybe most of us are asking the question, am I the last one to think about an AI investment? So this debate really overshadows running a diversified portfolio as we look out for the rest of the year. In fact, given where CD rates are, it's quite possible that the rest of the market has become a source of capital for Nvidia and a few other select themes. So with that, let's dig into the numbers, and I'll do my best to explain how we can reconcile this moment of fundamentals that are telling us to broaden the portfolio, look at growth rates, look at valuations, and at the same time, how these speculative trends, these themes can run even harder before we see a reversal. At the top of the list is this idea about profitability. After all, we believe that share prices track earnings growth. And what's really interesting here is that for almost 6 months, maybe a year, we've started to witness a bottoming of top line growth. The cover chart that we had published relates really just about every market globally. And what you're seeing is that just about every market in the last 6 months have bottomed. Some of the weakest points of where the profit cycle had slowed from the reopening peaks of 25% year-over-year growth on top line, collapsing down to a -5 in some instances. It's notably China, but even slowing down to a 3-4% handle for a lot of the key markets. And so this backdrop, I think, is super constructive for risk assets. That is, share prices move on good earnings. Importantly, though, if we look forward, what we're looking at in terms of the forecasts, this also supports that for over a year, the collapse in earnings estimates had really effectively stopped. And what we're seeing is that while it's somewhat mixed depending on which market we're looking at, just about every region we've started to see a recovery. The forward numbers are all climbing. The forward number for China is probably the exception to the rule. And so with this sort of area of comparisons, it is very tough to watch how few firms have really participated here. Tactically, though, and I've got to underscore this, tactically, the work does point to higher highs for the current leadership. As a result, it messes with this idea of like, where do we see this sort of rotation in the markets? In fact, as we're walking here, this fine line, there's no reason to get cute on some of the signals we're looking at tactically. As a result, that really led us to this idea about a barbelled approach, to look at a portfolio in totality. Really, if the AI spending remains as strong to some degree, it's really hard to walk away from that, and at the same time, continue to realize that there are fewer and fewer firms that get to this market cap level that we're witnessing right now. While we see much more of a broad value sensitive market, we can also see current leadership run to extremes before some meaningful rotation. All right, so let's take a look at some of the speculative run on the Mag 7. What you're looking at is really when we think about the performance, you're looking at several fold gains in terms of the Mag 7 basket. Nvidia, of course, dominates those numbers. What's also important, though, is that this sort of GLP-1 technology, the Ozempic type pharmaceutical plays, those have also taken stage. A few months ago, we raised this question of potentially speculation broadening. The idea is that once we get into this habit of looking at 10 baggers, that habit is hard to break, and we're going to look under every rock to find those types of names. So we think that in this sort of furious run-up, it's easy to see this type of broadening continue. We've seen this in other windows. If you go back even to the internet period where the stock started to melt up in that window, we also saw in parallel a massive biotech rally as well. So I think this is stuff that we have seen before. But with this backdrop, let's dig into the details. We've talked a little bit about the profit cycle that most economies in the world, we have seen a bottoming in the earnings growth. We're seeing a recovery to some degree. The question is, what about the other elements of growth, such as credit? And then when we look at the credit markets, and I think this is why it really forces us to scratch our head. We've got a bottoming in the profits, and we've got credit that is now historically easy. Within the wings, central bankers are ready to cut rates. So to some degree, this is something that is really very constructive of this idea that there is potential for a leadership change here, that to some degree, you're going to have growth come out of firms in all parts of these economies. And so this idea of leadership has really surfaced in a big way. When we look at other components of credit, even some of the most cyclical parts, we're looking at, for instance, building materials, banks and thrifts. All those spreads are recorded at historically low levels. One thing to think about, though, in terms of this leadership, and I think the team pulled together a really neat diagram on this, and the idea was to link the profit cycle back to Fed action. And to some degree, we've got to accept at the top or a peak of a growth cycle, Fed actions typically can be massive and disruptive for equity markets. In fact, effectively, it's a lights off switch for risk assets. Conversely, though, if you're looking at a profit cycle bottom and the Fed is reversing policies and central banks are reversing policies, by definition, that does shake up the system, but it's not a risk off position. It's really, do we see a rotation in leadership? And so that's what's I think super interesting in this moment. I think in the last couple of years, when we look at market rotations, we did see a fairly strong industrial recovery in performance. Since March of 23, however, the focus on AI has really flattened that out in the large cap arena. That had still continued to work, though, within the mid and the smaller cap arena. To some degree, the market's still pricing in a broader leadership, but you can't notice it when a handful of stocks are just up several fold. Importantly, throughout the last year and a half, the asset allocation models that we've built internally, that's the stocks versus bonds model as an example, that has been very pro equities the entire time. And in fact, in this latest rally of the last 6 months, the equity allocation has not really budged. Maybe last month with the very dramatic jump, it retraced a little bit. But to some degree, risk assets are really on the menu here. And it makes a ton of sense when you've got a credit cycle that's somewhat or very favorable. The question of inflation had really been dogged in the prior few years. To me, in the last 2 or 3 months, it is something that's kind of put me more at ease, that some of these comparisons, whether it's jobs, the inflation comps, they are settling. And to some degree, I guess if you shut the planet down for a couple of years and you reopen, you are going to have massive inventory misfires. And as a result, the inflationary spikes jump. And eventually, as the system settles, that starts to roll off. So to some degree, some of this is maybe self-correcting. The tight labor markets, though, is still something that I see as the real inflationary risk in the system. That said, these comps are settling and potentially more constructive, at least for now. So let me get into what has really sort of shaken us a bit, and that is as we call it, the Cirrus style oscillator. That is a reading that's made up of 6 to 7 variables that basically call for either an overweight to value or an overweight to growth. Now, as many of you know this, as some of you have been in this market for a while, in the last 20 some odd years or so, it has been a fairly strong growth market backdrop with fits and spurts of a value rotation. Potentially one example of this was really the reopening, where you did see that as we started to deal with a vaccine, as we started to come out of the pandemic, immediately we started to see deep cyclicals, transports, tourism, all of these reopening trades really started to really work. Effectively, a value run, very short-lived. In that window, this model never went to a value overweight. It went to a lean value. So the question is, what is going on that this model today has really gone to a fairly severe reading of value? And in fact, the last time we saw this was about 20 some odd years ago. There's a full paper on this. I urge you to take a look at it. But when we look back at the last 30 years or so, what we're seeing is effectively about 5 to 6 legitimate value runs. Importantly, though, the longest, most powerful run was the post-2000 event. That was really where the last time this oscillator, the CSO, had triggered to a value overweight. So it really does force us to try to reconcile and think about this moment. So to some degree, we've quietly had more of a value-sensitive market underneath the system. But since March of 23, very, very different large cap results. And because of the strong numbers, it's really dwarfed anything else in the system. A couple of things that came out of that report that was super interesting. If you look back into the 2000 era, not only did you have a meltdown in the technology sector, but you also had a stabilization in industrials and an industrial spending cycle, thanks to effectively China in that window. In this current cycle, in the last few years, we have seen industrials dominate for several years, really since 2021. It has continued, the industrial sector within the smaller cap arena has continued to outperform as the technology segments have continued to give up ground. The exception is in the large cap arena. Naturally, the AI sentiment has really driven the handful of firms that we see there. And so, in this current window, it does, really cause us to struggle, because I think enough of us have seen markets like this before, where, you get, massive companies that can grow, but how long can they accelerate? In this instance, we're looking at a $3 trillion market cap that's growing. Its revenue line on a year-to-year basis is over 200%. So for those of us who are saying that, why are we nervous? This is such a great company. For the folks who've done this before, they can say, look, we've seen this before. And, a lot of truisms are spinning in my head, such as trees don't grow to the sky, the laws of gravity will hold. And maybe more appropriately, as Cisco goes, so goes the market. That's a throwback to the 2000s, right? Because that was the sort of pick and shovels of the internet. And so to some degree, this is, why folks are more cautious here. To some degree, each earnings season we go here, we're more and more nervous. Do we get an adverse reading from Nvidia? At some point, does one massive company on spending say, we've invested in AI, some of it's been wonderful, but we think we're going to slow our consumption at this rate. So to some degree, this is really what keeps people up at night about this leadership. But the sheer mass of this sort of market cap, though, does worry people. $3 trillion growing at 200%. That's roughly, in 3 years, that's the US GDP. So let's get into what it is that allows this trade to continue to run harder. Number one, fundamentals matter. So the reality is technology spending, AI spending is incredibly robust. So we're going to chase this. The question, though, is, could this run longer? Could it run harder? And so as much as I would question a $3 trillion firm continuing to accelerate at over 200% on top line, things can run hotter than we think. We've seen this before, and I think this is a super important moment to step back and understand that markets do not trade to averages, they trade to extremes and then self-correct. And so this is something we have to deal with. Number one of the factors that are telling us that the current risk profile in the system could actually get a lot frothier. This has been an incredibly useful signal to us, where I referenced the Cirrus risk score. In that model, it's made up of, it's a diffusion indicator looking at a bunch of variables, such as, is high beta beating low beta, is are no income firms outperforming income firms, is higher quality outperforming or lagging, etc. At the end of the day, what this is telling us is that risk measures, yes, indeed, they had pulled back into the sell-off of the sort of reopening. And at the same time, they've really settled in. They've remained in a neutral territory. That's generally very constructive for equities. But where we're at today is not well above normal, because this reading has been a wonderful contra signal, meaning that when this signal reaches its highs, that the market is effectively very speculative, then the question becomes, who else is left to chase risk? And typically what we see out of this model are below average returns. And so what I have to harken back to are, really hard disciplined models like this that are telling me, hey, things could get more exaggerated. Bear in mind, in the summer of 2020, as we were all, chasing Zoom and a bunch of other firms, a number of folks were calling the narrow markets then, but that reading in here did not really peak until the end of 2020, so 6 months later. So in other words, the readings that we're looking at right now is just about longer term averages, or a little below longer term averages, but to some degree we could see this sort of reading get a lot more heated. And so this is the sort of stuff we're looking at to keep us more in line with how to reposition. Again, just about every model we've built at Cirrus, we're always testing them to say, like, okay, given that you think this is a good mix, this recipe is wonderful, can I make money on it? And what we have looked at are conditional returns for these readings. And to some degree, the expected return when the risk appetites are below normal tend to be subsequent 6-12 months later, you tend to see well above normal returns. So in other words, where we're at is a fundamental backdrop that's constructive. Companies are on the mend, forecasts are rising, credit's good, and at the same time, risk appetites are benign. This is a fairly strong place to look at for risk to continue to accelerate from here. Second really important signal is market crowding. We're seeing oodles of flavors of how narrow the market is. You've got all these statistics. If I sum the best performing stocks, take their market cap, that spread's never been higher, and so on. And so what I'm alluding to is this idea of narrowness in leadership. And the Cirrus model, we call it the Cirrus polarization quotient. I know it's a mouthful. It's for short, we call it the CPQ. But what we're doing is not looking at just performance data, right? Because if I look at the best performing names, then I take their market cap and I put it over the total market cap, all I've done is said, hey, winners are a bigger part of the market. I'm not sure that's very useful. Okay, so what this does is it's basically a valuation model. What we're seeing is that if you take the leadership stocks in the system, and we simplify it, we say, look, over time, looking at top decile, the top 10% of the large cap market, effectively 50 stocks or so, what's their median PE? And then what's the median PE over 30, 40 years? And what we'll find is that generally the market is trading between parity to the benchmark and a 50 to 60% premium. After all, these are stocks. The leadership basket represents stocks the market loves. So naturally, it should sell at a premium most of the time, right? And so once it gets over that sort of threshold, however, that sort of 50, 60% barrier, that's pretty much where we see the lowest expected return. Importantly, that is where we see a break in leadership. Relative, not only do we see lower expected returns once this polarization reading goes red, But we also see factors such as trending factors reverse on you. The best, most constructive variables as we get to that peak level, believe it or not, or to no surprise, valuations, valuations and quality. And so to some degree, we think that this signal that had fired in February, March to a red level, it's self-corrected with a sell-off in April. And so to some degree, we think there's more room here for this to run. Make no mistake about it. I think intellectually, we know this is a narrow market. However, what this is telling us is that these winning stocks, they're making money and they're growing hand over fist. And as a result, the market will look the other way in terms of all the other things that are keeping us up at night. Conditional returns at the heart of it. When this model is in neutral territory, whether it's the small cap market or the large cap market, we're looking at the highest expected return. We're looking at volatility that's below average in terms of higher expected return. Once it crosses that border, you're then looking at your lowest return. Your percentage of negative returns also start to jump. And so it's super important that, with this model, I do think we have to keep ourselves in check to understand that we have a good pulse on how much investors are willing to chase risk. This is telling us that there's still a window. Part of it, the contrast between this model and the popular models, is that these firms, unlike 2000, they're earning their way into their market cap. What worries me, however, is can we see a $3 trillion company continue to move north of 200% year over year on revenues? Not earnings, but revenues, right? So that's really, I think, the challenge for this window, because the folks that are in this stock today are the ones that have just entered because of the stock split. Are they the highest information trader, or are they on the lower side? That's the stuff that we've got to worry about. And at the end of the day, I've done this long enough. We've been around long enough to know that stock prices move on the acceleration of business. Nowhere more so than in the technology sector. So this is something that that we have to be thinking about. Ultimately, this technology that's wonderful, that's AI, it is about benefiting the entire system. So there is a distribution, dissemination of the benefits that will begin to spread. And I think that's the stuff of technologies. As they dominate market, they shrink, their footprint shrink, and you get other winners that surface because of the technologies. So that's I think super important to bear in mind with this period. So in terms of what else is changing, fundamentally, what is new, and I'll talk a little bit about this as well in the infrastructure, the industrial spending section. But the one thing that we have modeled is the sort of fundamental demand for technology goods and services. This is a model that we call the DDI, Digital and Deflation Intensity Model. What it relates is that in the last 2 or 3 years, this model has correctly called for a breakdown in that demand. And bear in mind, the only reason it has called for it is that what you had with the pandemic was a massive sort of early adoption, bringing in the demand curve for technology, goods, and services that was probably going to be there over a longer window, say 5 years or so. So we pull that into this period. And as a result, coming out of the pandemic, there was a ton of spend, a lot of upgrades. And to some degree, that is really what's sort of like been a dead weight on this sector. And that's why, unlike 2000, the technology run that we're seeing today has been very, very narrow. In fact, there's plenty of data that investors have seen. We've published a ton on it, on how there's this massive divide. So this speculative run has not been in large, mid, and small tech stocks dominating. Not at all. It's only been in the large cap arena. And so we think with this signal bottoming, it also gives maybe more credence to this idea that the technology sort of chase is not over because you don't have the headwind of this demand signal breaking on us. I don't buy that we're off to the races because for the very reason we're arguing that we're in a multi-year cycle for CapEx spending, it's the very reason that the market will continue to gravitate in that direction. But nonetheless, this is something that's a little bit of a less of a headwind that's been there the last 2-3 years. And I think we have to take note of it. Definitely makes my story tougher, but I got to call it out. And I think it does allow this leadership, it gives it a little bit more breathing space if some of the marginal spending patterns are starting to flatten out. That was weak post the reopening. And so to tie this all together, though, one of our analysts, Georgiana Fung, came up with this diagram, and I think it's definitely worth taking a look at it on the report. But if you were to think of this sort of market cycle in a clock face, the idea is that, what we've gone through has been sort of a bottoming and a recovery fundamentally. And now the question is, as that continues to ramp up, eventually we start to begin to chase leaders. And eventually it starts to get overheated. So if I were to place a marker in terms of where the risk appetite in the system is, if midnight is really the time to get out of Dodge, we're probably at a 9 o'clock reading for the risk appetite model. It is not 11, it is not midnight. And importantly, the other model, the sort of crowding model, as best as I see it, it's probably at 10 o'clock at night, not at 12 o'clock. Now, we know that might be further along than we know, just because that is a much more sort of hyper reading. But I do think that this is a really wonderful way to frame this. Now, what happens as this peaks, momentum factors start to break, value, quality factors start to run, short portfolios start to work, et cetera. And so leadership reverses. Eventually, you get a new sort of leadership forming, and then we get back to some sort of effectively a market bottom. The problem with what we're saying here is that if leadership breaks, we want to get cute about it. We want to say you can move into these value exposures, add protection, but this is systemic risk. And so there is something to be to deal with here, with the fact that if there is a break in leadership, I really doubt it's going to be very tidy. So it is something that, what we're thinking about is how do we add protection to a total portfolio, because we're not just running for the next 3 months. And so take a look at the report. I think the diagram you're going to find super interesting, very helpful and instructive. So let's put this together now in terms of portfolios. How do we position in our stock selection work, in our exposures, whether we're long or short? And so what we've built over the years are several growth models and several value models. On the growth side, clearly the large cap aggressive growth models have been the clear winners. But we are in this camp for more of a growth at a reasonable price prospect. The quality growth portfolio, I think, had done well about 6 months ago. We finally degraded that exposure, partly because if I'm arguing for the bottom of the profit cycle, easier credit terms, I don't need to pay up for insurance. Doesn't mean I want to buy terrible companies. It's just that, do we want to buy more protection as the dust is settling? And so the growth at a reasonable price model, and for that matter, on the value front, we're no longer running the quality value overweight. We're running a relative value model. We do think we want firms with a little bit of a grittier balance sheet, because to some degree they've been priced down. And if we're right about this sort of backdrop with credit and the profit cycle, those firms actually get a chance to really recover much faster. So in terms of putting the portfolio together, I think this is super important. Thinking about long versus short, the short book will struggle if tactically we're right. If we get this run to a more frenetic pace, clearly the value factors will break down harder. The short book will really, really hurt you. And but to bear in mind, we're tethered to this sort of like pivotal turn. We're not going to be smart enough to frame this. We know we've got models to monitor it and have some insight, add some English to the decision. But this is really, really sort of like the ultimate challenge in portfolio rotations. And so I think we're all struggling, with how to time this and how to think about this fundamentally. All right. So, effectively, what I've spoken about is a broader market. And, you can't really avoid the subject of small caps if you start thinking that the market's going to broaden. We've written work that have, this made a case for smaller stocks. The idea is that you've got some massive discounting, right? If I look historically going back as far as the 70s, I'm looking at the bottom end of relative valuations, whether it's small or micro caps. I think the micro caps gone even harder. So to some degree, there is really, healthy valuation comparisons, but does it matter? And I think what's important is that if we're talking about the likelihood of a value rotation, I continue to make the case that the smaller firms are tied at the hips with a value rotation, the entire idea of a broadening. That said, our size premium model is not flashing green for small caps. It's been fairly neutral. It did move away from a massive large cap overweight, but it is not really screaming an overweight in small caps as yet. And I think to some degree, I've struggled with this because shouldn't they be moving in tandem? And I think to some degree, what is going on here is that if we're right that we've got this frenetic sort of trending pace that might continue, by definition, that is a large mega cap stance. So this model just cannot be pushed over the edge as yet towards going small. But I do think the value rotation by nature will force investors into lower capitalization stocks. So to some degree, I think they really should be working together. But we've got a period here that you've got a massive sort of disconnect that's got to sort of reconciled. A few things that we have looked at recently that says that we're probably closer to a bottom with this value rotation, and for that matter, some stabilization, at least with the smaller cap, is this idea of corporate activity that we're starting to see some of that bubble up. If you looked at sort of the dollar value and the number of deals in terms of LBO announcements, we are starting to see that surface more again. It had sort of like gone really very quiet as the Fed began its tightening, but it's now, since then, has started to stabilize. Importantly, if we look to mergers and acquisitions, we have seen a really nice jump in terms of the deal sizes. The total count continues to climb. So the idea here is that if smaller firms are at severe discounts, and larger firms are carrying very rich multiples, that's a currency that's there to take advantage of. And so what we think is that while you can't claim that a consolidation story is the trigger for a small cap cycle, it's another data point that confirms the sort of value gap that we're witnessing. If credit is easier, and it's a critical requirement that credit access remain healthy. If that's the case, then this is likely to continue to accelerate. If you get some shrinkage in the capitalization in the smaller cap arena, it will reflect in the benchmarks. Years ago, we had written a piece back in, can't believe this, but 1999. We had titled the piece effectively calling for a bottom in the small cap cycle. It was called The Urge to Merge. And in that report, the idea was that the public market manager, they've been really beat up. They're not going to put the floor in small cap. The asset allocators are too worried about getting out of Nvida, so they're not going to move the allocation number yet. However, the organic move in terms of consolidation is effectively what puts the floor. So I like what I'm seeing. I think if you look at also the sort of high yield issuance, we have seen a really nice jump in high yield issuance. The credit spreads tell the whole story, as I said earlier, but it's translating into activity. And this is the stuff of effectively a reversal in the trends that we've seen with a very dominant large growth cycle. We do think there's real support here for broader leadership. in terms of looking forward, what are the models telling us? Here we are talking about barbells, and we've got, yes, you've got to make sure that maybe we don't question this sort of like speculative run, but we need to balance it out. Where are the models currently sitting, and what are they telling us? And so, in the interest of time, there's several flavors, and in the report we've got references to the exposures in our GARP model. As I've said, I think on the growth front, the GARP portfolio is probably one of the better places to be. In the value side, the relative value model is more important. If we look at trending in small caps, that's telling us 50 some odd percent exposure to the technology, and then financials, a smaller amount, and then consumer discretionary from there. But if we look at a forecast model where there's growth, there's reasonable valuation, reasonable earnings visibility, very different picture. What we're seeing is an overweight in healthcare, industrials, tech, and eventually energy, right? Radically different look if I'm looking out to where I see growth and at a reasonable price. So very different makeup than the trending basket. It is a time to start thinking about this, as the fundamentals are certainly leading in a different direction. One last subject that I've got to cover, because we've done a lot of work on the industrial spending cycle. We've been talking a lot about it. We've published a lot of good work on it in the last few years. It's worked quite well. We've had the industrial sector outperform really for 3 years now in the smaller cap arena, and then really for 2+ years in the larger cap arena, until this sort of Nvidia trade that just took over the large cap indices. But take a look at the spending data, because what we've noticed is that effectively industrial spending bottomed back in 2020, and it's been on the mend. What we're seeing in the technology spending data is it effectively flatlined with the peak in the reopening period, and since then it's gone sideways. This latest couple quarters, though, we have seen a bounce. Effectively, that may have been the AI spending data. But what I think we have to step back and sort of put into perspective is where we're at in the industrial spending story. And why we've used the term super cycle is that several factors that have come together since the pandemic have really forced more of a reinvestment in infrastructure. So part of it is that the geopolitical concerns that are abound right now. I think if some of us have been in markets for decades, the kind of hot and cold wars going on that we're seeing now, it really hasn't been around with this level of intensity in a while. That is generating things like nearshoring. Not only did the pandemic moment force us to think about nearshoring, but there's definitely been this realignment of partners, the sort of chaos in the system is forcing that. Effectively, nearshoring. What is that? It's a rebuild elsewhere, potentially inflationary, by the way. In addition to that, the Ukraine event forcing Europe to restructure its energy policy for the next decade. What does that do with energy prices, right? Effectively, what we've seen historically is that higher energy prices drive industrial spending. In my humble view, we're in a world where energy prices are going to stay higher for longer. And if that's the case, we are in the midst of an industrial spending cycle, not the tail end. And so the CapEx data, I think, has been very constructive since 2020. I do not think this is over because of the backdrop that triggered this moment. If anything, it might have gotten even maybe more confounding. So that I think is terribly important as we look to the portfolios. We certainly will continue to add and retain exposure to the IMEs, as I call them, industrials, materials, energy. It is more of a grittier kind of portfolio, and I think it fits for the moment. Taking a look at performance, it is remarkable that some of the details that get missed here. When we look at the larger cap arena, just this year, because we knew the numbers were better in prior years, but even in this year, if we look at the technology sector, it's up on average about 19%. Clearly, some of the Mag 7 names are up in the 20-30s, and then Nvidia is off in its own place. But to me, what's shocking is The deep cyclicals, materials and energy, they're up in 9 to 11%. This is through, I believe, the end of May. And to some degree, this is super relevant because an 11% run in industrial for the first 5 months of the year, if you annualize that, that's not terrible. But right now, we're not going to notice it. If we look to the smaller cap arena, the IMEs have been dominant. The industrials are up about 12%, 10% for materials, energy is up about 11%. Technology in the smaller cap arena, it's down 3%. So to some degree, we're looking at a tale of two cities. I think this is continuing to run its course. And really, it does tie together this bigger picture story where we've got this sort of narrow sort of leadership and AI investment cycle. And at the same time, you've got a profit cycle that's stabilizing where more companies are going to make money. And I do believe in the long run, share prices chase earnings. In fact, if we look at the infrastructure indices that we've structured over, in the last 4 or 5 years, whether it's large, mid, or small, these infrastructure baskets have outperformed. I will caution you, though, the infrastructure basket, as Cirrus has defined it, includes technology groups such as semiconductors. That is modern day infrastructure. The high-end AI chips, another story, but I think it does lead back to this idea of infrastructure and rebuild and reshoring and all the terms that we're now so much more familiar with than just 5 years ago. So let me pull this all together now. What we've talked about is there is a rebound, global rebound in the earnings cycle. We've got easier credit. And at the same time, we've got central bankers that are really on an easing circuit. This directly conflicts with the idea that you've got a very narrow market or a narrowing market. I do agree that, we'll see when you get super aggressive growth rates in certain themes, whether it's Bitcoin, GLP-1s, AI, absolutely you will see markets run there. But to see the entire system stand still is a little bit of a mystery when we're at the beginning of a stabilized earnings cycle. So I do think there's some reconciliation that has to occur here. I would say plan ahead with the portfolios when nobody's going to be smart enough. I love our indicators. They're not going to be perfect, but it's telling us that there is a little bit of a clock ticking. The value overweight reading, we haven't seen it in 20 years. I would take that to heart, given everything we've covered. The tactical readings, though, make no mistake about it. Markets go to excesses. These indicators are telling us that we're shy of those excesses. Timing wise, it could be 3 months, it could be 3 quarters, but we'll continue to watch them to sort of understand where we're at. There is a fundamental overlay to this rotational story. I think a corporate effect is this idea about the urge to merge, likely to place more of us flooring in small caps. I am really struck by how low the small cap returns are. I don't think, I kind of agree with our the Cirrus size premium model that it's not we don't have the makeups of the classic small cap cycle. And what I mean by that is that you don't really have the churn and burn backdrop where, out of the ashes comes small cap. We never went into an ugly, deep recession. We never had credit spreads blow out to crazy heights where as they began to correct or self-correct back down to normal, that those quarters were your best performing small cap runs. We don't have that backdrop here. And that's why I never questioned that we could necessarily get this massive small cap run. But globally, we are looking at just about every market where the secondary markets are really on their heels. And I do think from a positioning standpoint, super interesting timing. And then to close, CapEx. I think this is one of the biggest deals in positioning in the market. Underneath, I think there's lots of reasons to see these industrial spending cycle continue to work. If we were to stop today, reshoring, if we're shaking hands with China and we're all friends and Ukraine sort of magically goes away, maybe it changes. But I don't think that happens in the next few months. So with that, as always, we're happy to take questions. Please reach out. And as always, we love the feedback. Please keep it coming. Good luck for the second half of the year, and look forward to working with you folks. Thank you.